Afternoon, everybody. Thank you for joining us today. As a quick introduction, my name is David, and I work in the research team at StuRents. While we're waiting for the last few people to join the webinar, a few bits of housekeeping just to take care of. So firstly, the webinar is being held to coincide with the release of our standard quarterly reports, which should be released in the next few days. This session is being recorded. We'll make sure that everybody on the call receives a copy in due course. So as always, we are pleased to be joined by an industry expert who's going to be sharing their views on the market. We'll be continuing the discussion at the end of the presentations to answer some of the questions that you've submitted. So while we've had a number of questions submitted already, if you do have any questions for the panel during the session, please submit them via the Q&A function in Zoom, and we'll try and get through as many as we can. So on that note, I'd like to introduce our guest for today. So Raffaele, are you able to kind of give us a quick introduction, background?
Hi, my name's Raffaele. I'm a founder of LocateMe, which started about 20 years ago when I was at university. Feels longer when I say it like that. And there's a few ancillary companies that we've set up around the student world since. But yeah, today I'm going to talk about a few of my passionate topics.
Great, thank you. Yeah, we look forward to hearing from you shortly, tackling some of the questions that we have in. So before I hand over to Richard to run through today's data, we do have a number of poll questions that will be appearing on your screen shortly. So first question is, what are your rental growth expectations for the 2025-26 period? The second question is, what are your expectations for international demand for 2025-2026 compared to last year? And lastly, how has your overall view towards the student accommodation market shifted over the last 3 months? So yeah, just put your answers in there. Want to note that the poll can be minimized once you finish answering, or you can move it out the way. And on that note, I'm now pleased to hand over to Rich to run through today's data.
David, if you bear me 2 seconds, I'll just share the presentation and we'll get started. Perfect. So hopefully everyone can see that okay. Just again, a quick recap for anyone on the call that's new perhaps to these sessions. So a quick overview in terms of what we do as a business. So I guess they're going to break us into 3 distinct parts. We have the listings platform, so StuRents.com. That's been going since 2008, and we currently list, roughly speaking, about 750,000 beds nationwide. We are also a leading provider of property management software to the industry, and that's through our separate brand called Concurrent. And to date, we've actually executed over 3.3 billion in tenancy value for our customers. And then from a research or intelligence standpoint, we can leverage those 2 platforms and obviously supplement that data where we need to provide highly granular insights to a real kind of range of stakeholders within the sector. In terms of the topics we'll be covering today, so we're going to start off with somewhat of a deep dive into the latest clearing data produced by UCAS and just have a look at what those trends are telling us. We'll then revisit the latest PBSA occupancy or leasing data, so see how that is performing year to date. We'll then move on to the latest student search behaviour before looking at the latest plan application activities. And then we'll pass over to Raffaele from LocateMe. And then finally, as David's alluded to, we'll hopefully have some time at the end to do some Q&As as well. So to start off with, covering the UCAS data. So we wanted to kind of dive into this. It is worth noting that UCAS actually produce daily updates to this data. So it is worth remembering this data will change. And actually the charts we're about to go through are representative of 12 days after results day. So again, there's going to be daily updates to these. Starting with the, I guess, headline numbers split by the kind of key domiciles. What we can see is so far, again, 12 days after results day, the total number of acceptances are up by 2.7% year on year. We can kind of see the long-term trend on the right-hand side. So interestingly, kind of coming out of COVID, we saw a bit of a dip in those acceptances, but that has now started to recover, which is great to see. If we break that down by, again, the 3 key domiciles for the time being, so from a UK perspective, those numbers are up 2.6%. The reverse of that, numbers from the EU are down by 2.6%. And then particularly important for PBSA, obviously, non-EU numbers are actually up 4.5%. So some interesting or positive trends there, particularly from the UK and non-EU numbers. What is worth noting, as I say, these figures will continue to change. However, if we look at the figures around 12 days after results day, it typically gives a very good indication of where the final figures are going to land. So whilst the underlying numbers may change, the trends should be there or thereabouts by the end of the cycle. The other important thing to note or to remember is this only covers undergraduates. If you actually look at the latest HESA data, and most will be aware of the issues there in terms of timeliness, as it only goes up to 2023. But in 2023, roughly speaking, about half of all international students in particular were actually postgrads. So we don't quite know what's happened to postgrads yet, and we'll come back to that a little bit later. What's also worth noting is actually, if you look at the HESA data, as I say, that only goes up to 2023, the data from the Office for Students, which is data we have previously explored, does show a decline in postgrads in 2024. So again, that's worth noting. The other interesting trend from this particular chart on screen at the moment is how, because of those continued declines in EU acceptances, they now equate to just 2% of the total, and that's down from 6% kind of around Brexit time. So again, they are really not making up many students if you look at the grand total. Diving into the UK data in a bit more detail, and specifically looking at the trends but based by different age brackets. What we can see from the navy line in this particular chart is acceptance growth in 18-year-olds in particular has been strong, and it has actually accelerated year on year. So again, at this stage in the cycle, those numbers are up 3.7%, and that's slightly better than the same period last year when they're up by about 3%. So good positive underlying growth in that 18-year-old demand pool. What that means practically, interestingly, is that that is a good driver for demand for HMOs and more affordable PBSA, given that most domestic students typically have lower budgets than, say, their international counterparts. What we can also see from the line chart on the right is that continued or steady decline in demand from older groups of students, so 25 plus, for example. Moving on, and something we have raised in a previous session that is worth keeping an eye on, is the proportion of the population that are actually going to university, again, from an 18-year-old perspective. So hopefully most on the call are fairly familiar with the kind of macro trends around UK demand. So just to summarize very quickly, we obviously had that period of a declining 18-year-old population, but that was being offset in terms of an increasing amount or proportion deciding to go to university. And we can see that represented in the chart on the right, where between 2016 and up to about 2021, we saw that continued growth in that participation rate. It was possibly somewhat concerning. We saw that started to decline in the last few years, but actually that has now recovered, which is positive to see. And so far in this cycle, we're pretty flat. So again, that participation rate is looking steady at least, and not continuing to decline, which is maybe surprising given the lot of rhetoric around cost of living and the cost of university, for example. What that does mean though going forward is if that proportion or entry rate stays as it currently is, we're obviously now in this period of growth in 18-year-olds. So that's going to be bullish for undergraduate and UK demand in particular going forward. So it's one to keep an eye on, as I say, but actually the latest data I would say is pretty positive in that respect. Moving on and looking at some key countries of origin next, particularly of interest for PBSA, obviously. And if we start with demand from China, which is, again, the navy bar in this particular example, we can kind of see that volatility in undergraduate demand growth kind of post-COVID, really. So significant growth in 2022. That then fell away somewhat, but actually, again, we're moving back into positive territory for 2025. And if we look at the numbers, they're up almost 15% year on year at this stage in the cycle. So pretty significant increase. Equally, if you look at the long-term growth in that Chinese demand, we can see it is up about 63% compared to 2019. And if you were to put a straight line through that navy bar or navy bars, it's very much on the upward trajectory, which is, again, interesting to note. Something we've been discussing here internally is how long that can continue. So that's something we're potentially going to do some more research into in the coming kind of weeks and months. Meanwhile, from an Indian perspective, growth has stalled. Numbers are down 10% year on year. You can see that as represented by the kind of orange bars in this case. US demand is up almost 10%. And the other one that's worth calling out is Turkey. So Turkey has seen significant growth again year on year, so up about 25%, but that is from a relatively low base. It's also a slight reduction on the previous year, when it was reporting growth about 34% year on year. So some interesting patterns there, but I think, again, the main takeaway is that particularly Chinese growth has returned, and that long-term trend still looks pretty strong from an undergraduate perspective. Moving on to look at the data by split by various tariffs next. And by tariff, what we're really talking about is the requirements to go into a certain university. So those classified as a higher tariff are the ones that are going to require higher grades. And really this illustrates the flight to quality trend. That's something we've been talking about for a number of years, to be perfectly honest. I think where it might start to become somewhat interesting, and we have seen this in the news more recently, is a bit of a spat between various VCs from universities, with some claiming that Russell Group universities are hoovering up demand. And that is broadly reflected in this chart. So if we look at the numbers here, the trend is pretty clear. Those higher tariff providers have continued to report growth over the long term, and that's really been to the detriment, particularly of lower tariff providers. And we can see, if we look at, again, those classes higher tariff, as of 2025, about 37.7% of acceptances were going towards those particular universities, and that's up from about 30% in 2016. Whereas the opposite is true for those lower tariff providers. So they've seen their share drop pretty much from the same position, so about 37% down to about 30%. So clear long-term trends and a clear preference for high tariff providers. Looking at the same data next, but particularly focusing on non-EU students, the chart on the right is displaying this data in a slightly different way, but it allows us to illustrate the long-term change in those acceptances. But the trend is even more stark. So again, if we take high tariff providers, significant growth over the long term, about 15,000 additional acceptances at this point in the cycle this year versus 2016. Whereas if we look at medium or lower tariff providers, very little growth over the long term. Looking at the figures for this year in particular, medium providers down just over 5%, lower tariff providers down almost 12%, whereas those higher tariff providers up 10.5%. So again, significant growth at those more prestigious universities. If we look at the share, then again is very stark. So higher tariff providers taking up 70% of those non-EU acceptances. Medium providers about 20% and lower providers less than 10% now. So again, that trend is very obvious. I think, again, I mentioned VCs, and there's been some news reports in the Times, I think it was. It's one that's worth being aware of. I think there has been one particular VC who had suggested there should be caps in place in terms of what percentage growth can be reported by university. Obviously nothing in place at the moment, but it's worth being aware of and keeping an eye on. Moving on to PBSA leasing velocity or occupancy next. And what this data is showing is the proportion of beds that have been let, either for studios or clusters, which we'll come on to next. And this is based off the members submitting data to us directly. We have about 180,000 beds taking part in our monthly survey. And what the data shows is that as of July, for studios in particular, there were about 66% let. And that's down from about 77% the same period last year. What I would say, and we have said this in previous sessions, is some of these year-on-year comparisons may not be the best benchmark, given particularly strong fundamentals in, say, 22 and 23. But again, it shows how the market is leasing up. We'll explore the velocity in a bit more detail shortly. But moving on to clusters next, a similar-ish story, about 65% let as of July. Again, down year on year, but actually what you can see from this particular chart is that the levels are really pretty much banging in line with where they were in 2022, which is interesting to note. Looking at studios again, but just a slightly different way of analysing the data, what this particular chart is showing is the percentage point gain recorded each month for studios, either for this current cycle or the cycle last year. Now, if we take the orange bars, which are the 25-26 cycle we're currently still in, we can see that in most months that was tracking behind the gains reported for the equivalent period last year. And that we just saw because we are down from a year-on-year perspective. The reason though we wanted to highlight this is if you start to look at the figures for May, June and July in particular, we can see that actually the percentage point gains are now higher than where they were for those equivalent months last year. So what that means practically is that year-on-year spread is now starting to narrow. So we're starting to see a narrowing of that spread, which means a slight improvement in velocity and improvement in position. Obviously, August is going to be a very key month. I think anecdotally, we have heard some markets picking up for August. We're going to have to wait till obviously the end of the month to see how that final figure, what it looks like. But at least there's some positive signs here in terms of that velocity has started to improve. Obviously, the big question still remains, will this cycle be slower or will it be lower? I think it's going to be very much a mixed bag. There'll be some markets where we see that recovery continue and the end position is probably similar to last year. However, I do think there are some markets that are at risk and they potentially could be down as well. Looking at the same data again, but from a cluster perspective, it's a similar story. So most months we're tracking behind year on year. However, similar to what we just saw for studios, in June and in July, we're now starting to see improvements. So for example, we can see in July, 7.9 points were gained, and that's compared to about 6.5 last year. So again, a slight improvement in velocity, but we'll be keeping a close eye on that over the next month or so. For anyone that's interested in the occupancy data, do feel free to reach out. As I say, we're tracking about 180,000 beds each month. We're now reporting that on 25 individual locations as well. So anyone wants to take part and start to receive that data, do reach out to myself or the team, or feel free to scan the QR code and we can obviously jump on a call to run through that. But moving on to search behaviour next. And this is specifically looking at data for Q3 to coincide with the quarterly reports, which David mentioned. And that actually refers to the April to June period just gone. For anyone on these calls that have sat on previous sessions, they'll be familiar with this chart. But just to very quickly explain what we're looking at, this is showing the distribution of searches based off unit size or the number of beds being requested by the particular student. So if we look at the data for Q2, for example, that was showing demand for 2 beds, 3 beds, 4 beds, etc. Whereas for Q3 just gone, we're now starting to see that shift towards the smaller sizes. So greater demand for studios and again, those smaller unit sizes. If we just pick out that key number there, so again, for Q3 just gone, about 42% of searches being performed on the platform were for 3 beds or more, and that's down from about 59% in the previous quarter. That trend is expected, so we do see that each cycle, and we would actually expect that to continue. So what we'd fully expect for Q4 is again a greater proportion of searches being performed at those smaller sizes. So again, studios, 1 beds, 2 beds. And that really, I guess, illustrates or reflects the seasonality within the market, with typically domestic students searching early in the cycle, but for more beds, and internationals later in the cycle, typically, or not, albeit not exclusively, for fewer beds when they're house hunting. Next, we wanted to dive into data based on executed contracts, just to give some additional insights, and starting with particularly those that have been signed by British students. So the data on the right is showing at what price, on average, was being executed, either in the HMO market or the PBSA market, again, specifically by British students. So we can see over the last few years, that trend has continued to rise. If we look at the data so far this cycle, from a headline rental perspective, on average, HMOs about 4.5% increase and PBSA about 2.3%. However, it is worth noting, and again, something we have raised in previous sessions, the impact of contract length, which is not currently reflected in this chart, but we have shown this previously. If we then take contract length into account, those numbers actually come off slightly. So contract value growth, which is taken into account the headline rent, but also the tenancy length, was about 4.4% for HMOs and about 1.8% for PBSA. One of the reasons we raise that is that contract length will impact the value, particularly as we enter the end of the cycle. So typically, if property managers are having to execute contracts at shorter tenancy lengths, that's going to bring the contract value growth down. So again, that's worth being aware of. Looking at the same data, but from a Chinese tenant perspective, again, it's a similar-ish story. We can see the long-term trend over time. Looking at the headline rental growth, about 4.2% for HMOs and about 2.9% for PBSA. But again, very similar. Once we factor in tenancy length, those numbers do come off slightly, and PBSA in particular drops to about 2.5% in terms of contract value growth. What's worth noting in this particular chart is it's not weighted. So if we are to look at, for example, all the tenancies being executed by Chinese students going through the platform, more than 80% of those are signing their contract for a PBSA. What it's also not doing is factoring in timing. So again, that's just worth being aware of with regards to that line chart. Moving on to planning next and just having a look at some of the latest activity there. Again, a similar chart to what we've shown in previous sessions, but what this does illustrate is how we did come out of this somewhat of a slump in terms of number of beds being submitted and approved, and we start to see that increase. But if we look at the chart on the far right-hand side of those lines, that has almost collapsed. And actually, if we look at the number of beds submitted year to date, is less than 15,000. And that's down well over 40% year on year. Similar story for those being approved. They are down again significantly, about 40%. Obviously, the Building Safety Act is going to be playing into that. Yeah, competing use cases, debt, everything else. But interesting just to note that that activity has now started to come back off. In terms of where those beds are being submitted, so over the last 6 months, really focused again in some kind of key target cities. So as you can see from the chart, Manchester, London, Bristol, Edinburgh as well, is where most of those beds are being submitted. What is worth noting, though, is that that activity can be skewed by some relatively large applications, some in Manchester, for example, which we'll come back to shortly. But you can see really that activity is focused in relatively few locations, top 5, for example, equating to 70% of beds. In terms of total current pipeline, similar story, Bristol, Manchester, Glasgow are the cities with the largest pipelines. Having said that, analysis that we have run previously, particularly in these active markets, is to look at historical numbers and basically comparing the percentage of applications being put forward to those that actually reach practical completion. And in some markets, that can be less than 40%. So while some of these cities do have significant pipelines, obviously it's unrealistic that all of them are going to get delivered. And again, in some markets, that could be a real fraction of the total. And given the current difficulties around development, that number could actually come off further as well. In terms of some notable submissions and approvals, I'm not going to read these line by line necessarily. And again, this is just a subset. But as I just mentioned, there have been some significant applications. The kind of joint venture between Unite and Manchester, we can see there, which is over 2,000 beds, and some other pretty significant developments as well. One final slide just to finish on. Again, we have covered supply and demand in previous sessions in more detail, but we wanted to just give an updated view to this. What is worth noting is that this particular analysis is looking at the national outlook outside of London, but we do produce this every single month across more than 40 locations. And that data is actually now available within our data portal. So for users that want access to this on an ongoing basis, that is now readily available. To summarize the chart on the right, for anyone not familiar, what we're really doing in our analysis is we are tracking the change in demand, which is represented by the blue lines, and then we have various growth scenarios, which I'll come back to. And then we're comparing that to changes in supply, which is the orange line. So to summarize, what we can see is that between essentially 2019, particularly post-COVID, so 2021, for example, demand growth significantly outstripping supply growth. Now, for 23, numbers did come off slightly, according to HESA. As I mentioned at the start of this call, the latest data from the Office for Students, which actually goes up to 2024, suggests numbers may have actually come down again that year. We can't confirm that until the HESA data is released. But if we take a view of flat growth or no growth in 2024, and then project forward a number of different demand growth scenarios, so in this particular case, 1%, 2%, and 3%, we can then start to understand what might happen to market fundamentals going forward. So again, if we are to recap on where the market has come from, 2022, for example, that spread was particularly large. It then fell slightly, and for 2025, we can see that has definitely narrowed, and that's reflecting the somewhat more difficult conditions this year compared to, again, the years post-COVID. But positively, if we look forward and take that grey dotted line, which is just 2% growth per annum, which the market has seen historically, then actually that spread could start to widen again. And what this illustrates is that actually it doesn't take much demand growth for market fundamentals to improve. There are obviously a number of caveats to this. For example, we've already discounted the pipeline to assume only 40% of beds are delivered. But I think the long story short is that actually looking ahead, if we do see a return to demand growth, and again, it doesn't need to be significant, then we could see that spread again start to widen, which will be positive for operators and investors. As always, though, it is worth just remembering those fundamentals will vary significantly per location. And again, we've dived into certain locations in previous sessions. So to summarize, undergraduate demand as of today, and the latest data from UCAS does look particularly strong, specifically from China. As I mentioned, though, we don't quite know what the outlook has been for postgrads, so that is worth bearing in mind. The flight to quality trend is still very much apparent and is probably more apparent than ever. So that is one that's worth keeping a close eye on in terms of news stories. With regards to occupancy, we are seeing a slight improvement in July, and we would probably expect that in August as well. But I think the big question remains as to where we will land kind of come October, November time. I do think it will be a mixed bag. As I mentioned, there will be some locations that are on par, but I do think there are some locations that are certainly at risk of being down year on year. More positively, though, for operational assets, as we saw, planning nationally at least has somewhat stalled. That's going to be positive in the long term. And as I say, that feeds into that kind of macro outlook as well, which again has been quite volatile in the last few years coming out of COVID. But if we do see a return to demand growth, things possibly could improve going forward. Just before I hand over to Raffaele, just a quick announcement to make as well. So in November, I will actually be in Singapore for the week. We're doing a joint event with Allsop and Millennium Group. So any of the listeners in today's session that happen to be in the region, obviously we've spoken to quite a few already, do reach out and we can obviously have a chat about what that event entails, and obviously happy to answer any questions as well. That's enough of me. So I'm really pleased to kind of hand it over to Raffaele now, and look forward to his presentation. And as I say, we'll try and tackle a few questions afterwards as well. So Raffaele, over to you.
Hi, everyone. So yeah, I'm Raffaele. I started Locate Me 21 years ago, so 2 decades ago, from my student bedroom. and lots of ups and downs in terms of growth. But we now sort of look back and we're managing £500 million worth of predominantly HMO. Predominantly HMO and boutique PBSA sort of size properties across 14 cities. I used to live in a HMO myself, so the company sort of commenced. My first office was in a HMO. I'm not sure my landlord was aware of it, but it did start there. And I went to Loughborough University. I lived in HMOs, and then I felt like I could potentially give landlords more exposure than what they were used to, or at least bring some sort of marketing tactic to renting out their properties. Over the years, we have managed landlords from one property, local sort of parents type landlords, and we've gone all the way up to 300 plus landlords. Those landlords vary in demands and vary in expectations and vary in sort of knowledge. So your local landlords are craving a systematic sort of way of not giving them any hassle. Sometimes they're very hands-on, sometimes they're very hands-off. And the larger guys are, all OPEX, CAPEX, and all investment related. And we've had to adapt to take it from a company which is very used to having the landlord come in for a cup of tea to reporting to landlords every week on a live API. Over the years, we have grown in different areas. One way in which we grew as a management company is I started to create my own portfolio. We've managed to sort of build up a 250 property portfolio, predominantly in Loughborough, just because it's local and the opportunities came up there originally. Over a period of time, we started to invest entrepreneurially in different areas because of opportunities rather than actual patterns. Learned a lot, and we walked a lot of streets, and we chased some yields at a younger age. And then over the years, we've managed to consistently learn that there is a innate pattern to winning and losing universities, as Richard has already sort of spoke about. And there is also a real success story in owning a great product rather than just owning rooms. And I was very obsessed with growing rooms at one point, and now I'm pretty obsessed with owning a great product. I have learned quite a few things, like what's easy to let and why, the property cycle stage. So when you're buying a property, just a quick question to ask yourself is, when did it let last year? And did it let in July or October, just pre-commencement, or did it let very early in the high velocity season? Meaning that it's easier to let and costs a lot less, and there's less chance of you having to reduce your rent. So in a consistent cycle of creating sort of premium, well-located, Instagrammable products, and always remembering that we are trying to create a home. Although it's for 1 year, there is a home in the back of everyone's mind, and we believe that through all the feedback we've had at Locate Me, there is a real understanding that the truth is there probably isn't a student housing crisis in terms of properties needed. There probably is a lack of understanding of the product that we're supplying, which leads me on a little bit to the silent threat to your returns, and what we're seeing over the years. There are a few different elements to this. I'll give you an agency perspective, and then I'll give you a landlord perspective, just because we do see it from both sides. And we also see it from Yield, our sort of sourcing arm around the shoulder and advising around what property investments to make. So cost of lettings is a big topic for us, because we're seeing this change an enormous amount. And if you can see through some of the trends, in essence, the cost of letting is increasing dramatically. And really, although rents are increasing, so is the cost of letting. And one of the things that we have been very aware of is that gap is growing and people are becoming more and more sales orientated than product orientated. Gross rents look healthier on paper, but the net returns are eroding pretty fast. And we're having a lot of landlords request, higher rents, potentially not looking to increase the quality of the product, which means it inevitably, on an exposure level, an agency needs to market that property a lot more. Marketing budgets are up 30% just in a few years. More portals, more social media, more staff, more agents, overseas agents helping find overseas tenants. We're told there's sort of around 230,000 beds missing in terms of shortfall, but the reality of it is a lot of properties still have empty properties, and that's across PBSA and HMOs. We visit a lot of these properties, varying of size, and what we're finding is that everyone is struggling with the marketing behind it. So the wrong products cost you a lot more every single year. And what I would like to see is people, rather than spending more money on selling beds, they spend more money on creating a better product which lets itself, so that the yield stops being killed by the marketing costs. There is only one way to consistently fight against that compression, and that's to invest in a product that is in demand. And the reason why I say that is because what we find is that there is inevitably a very fast route to letting your property, and that is to have a great product that doesn't need a fantastic sales and marketing campaign behind it. And you don't need to go down the avenue of incentivizing and giving cashbacks, 3 weeks, gym memberships, and all the other things that you've seen out there. And our job at Locate Me is to make sure that we are fixed in our marketing costs, but then that makes our job hard because we need to just make sure that we make profit within the margin that we're charging you. But if your marketing team is in-house, or you manage these properties internally, the big project for everyone in this market is just to make sure that this silent killer of rental income is controlled, and your bedrooms that you're trying to sell aren't costing you a lot to let. Which leads us, the single biggest truth in student lettings is rooms don't rent themselves, but products do. And we have really struggled to convince sort of our historic landlords to invest as much money as they invested in buying the asset into investing in the product, which is a really hard investment to make at the moment with construction costs. But we believe there isn't a shortage of student rooms. We believe that's probably aligned a little bit with the higher ranking universities. So there is a shortage in some of the higher ranking universities, and in some of the lower ranking universities, there isn't a shortage because the demand's not growing as much. Students are buying an experience, not just square meters. We can't keep on acting as developers. We need to be acting and listening to our customers. Every student needs somewhere to live. That's not going to change. And when that place is safe, well designed, and in the right location, they don't deliberate, they just decide. And one of the big things that we have been working on at Locate Me is trying to understand this table, which is on the screen. What we are finding is that a great product in a great location, in essence, you can let it within a couple of weeks. You're only doing 1 or 2 viewings on it. It's let in the main season, or 95% of it is let in the main season. Voids are less at risk because of the groups, and tenant retention's really high. So we're finding friends are recommending the property, tenants are staying on, they're finding alternative housemates. And the truth behind it is, Locate Me's experience is that there is an enormous amount of cost to having a property that sits in the good product tags and the bad product tags. And in reality, Locate Me can rent a property much quicker if the product's good. Exposure does help. So using a large agent, or using an agent, or using someone like StuRents, allows you to create more exposure to your properties. But the old tactics of free rent, overpaying, short-term fixes, discounts, it isn't sustainable. And what we would like to do is educate the buyers that are coming into the market, which is obviously changing dramatically. I believe that we can basically improve the product and make marketing costs reduce dramatically. So if we could realize that within the purchase, marketing and how marketing has been produced for that product prior to purchase, we can kind of make sure that a poor product creates, the lettings nightmare, slow inquiries, endless viewings, your agent spending more money, you're losing more in rental weeks, marketing costs, and then a great product delivers an efficiency funnel, which is in essence the key solution to getting the property let, which once it's let, the money's coming in and you can focus on your operational costs. But these OPEX costs are prior to actually letting, which is what is really eating up and not being seen in the OPEX calculators. And rooms, really, they don't rent them, they rent themselves, and the product really needs to be focused on because the tenant has changed over the last 20 years. And, daylight, and all of the small things that we've sort of eradicated to produce more effective developments has sort of enabled the BTR market to step into our shoes and create a better product. And some of the statistics probably are struggling to show this, but lots of students are actually signing up in the BTR market, where the BTR market has hit sort of Leeds and Manchester area. This follows on to my slightly quirky idea of how we work at Yield and Locate Me. I've sort of managed to sort of draw it out to give you an understanding, is that although the spreadsheets are very key to every investment that you ever make, there is an emotion behind some of this, and there's some sort of parameters that I always just sort of say to everyone that invests. And one of them is the ingredients. So yes, numbers, spreadsheets, net rents, consistent rents, annualized rents, and stabilized rents are really key. What date does it rent for? It's a really interesting question. We learned quite a lot from a property of how did it let? Was it with an agent who charged you £600 just to find the tenant, or was it they just walked in the office and they'd already seen it, or their friends recommended it? That's a really quick win on working out whether the product is in demand. What does it cost to let? Are you paying for extra viewings? How many viewings were there? What date was it? Was the rent reduced? Was it the first tenant that walked in the property, the first viewing that created a let? The next thing is location and product assessment. Now, location is obviously city-based, as the guys mentioned at StuRents. But are you on the right streets? Have you walked the streets? Have you asked the tenants in the house why they chose the house? How do they feel about living in that community now? Because some of these larger cities have very unique roads where you can be on one road and it's fantastic, and you can be on another road and it's not the same experience. Are you investing where students live and enjoy? That's a really key question that I keep asking. And unfortunately, it's very hard to fit in a spreadsheet, but with some questions on your viewings, you can kind of understand that. Are your room sizes, amenities, locations sustainable if the market changes by 15%, which inevitably, with the growth in the market and PBSA and BTR and the HMO market really having a lot of change of owners and change of product. There's the emotional walkthroughs, which I won't bore you to death with, but what would the parents think? Would you live in the house? Does it feel like home? Do I feel safe? Are you walking down an alleyway that doesn't have lights? Can you change, the problems with the house? Second and third are predominantly the method, which is, if you have a house and it's a high price, you want to achieve a lot of rent for it, and you've got a really good product. then you need some high exposure. So you need to be showing quite a lot of tenants around because you really want the highest price in the market, but you have got the highest product. Then the low price, so low expectations, but high product. You know, you don't need to be with an agent. You can rent these properties yourself, and they're usually let with one or two viewings. And then there's the misalignment in the market, a low product, a high price, and a high exposure. This is an agency's nightmare and probably a landlord's nightmare because inevitably the price will have to be reduced over a period of time. And the last thing we do as an agency, rather than a sort of sourcing agent, is we say, where are you in the market? How many good products are on the market? How many well-priced products are on the market? And, you know, only can the price change if the location's fixed, the product's fixed, you know, then the price needs to change to adapt. And there's a velocity period in the HMO market in particular, but also in the PBSA market. And with the renters reform, we are inevitably going to see that become more and more important. So positioning in the market is really key. A killer stat, which the office have been working for me for a while, and I'm not sure they've enjoyed it because it sort of can vary very quickly. But I'll leave you with this. I actually think there's a 20% swing in annual income per property. And it's not coming from chasing an extra 0.5% when you're buying the property. It's actually coming from buying the property right, investing in the right product, and then letting it with zero friction. Now, whether you are the agent or you're the owner, the big thing that we're very keen on educationally is that you have to buy right and you have to position yourself right. And the demand is there, but the supply, we're buying in the wrong locations and we're providing the wrong product. So just be aware that with market changes and when we're winning and losing universities, the product is becoming a lot more apparent. And that's me. Every house has a story. That's Locate Me's slogan. But yeah, thank you, Richard and David.
Appreciate that. I think certainly that the cost of let or cost of acquisition is a topic of conversation we constantly have. And I think it's an interesting one because again, I think there's more education that's needed in the sector. But again, we might have conversations where, to take your example, someone might receive 50 inquiries and think that's good value, but actually one inquiry that converts to one tenant is actually better value. So I think understanding that cost of acquisition and let is definitely a key thing. And obviously we're seeing that in the PBSA market as well. Just before we kind of hand back to David, again, anyone that wants to keep up to date with our data in the sector or wants monthly updates on PBSA leasing velocity, do keep an eye on LinkedIn, but also do feel free to subscribe to our monthly newsletter as well. I'll stop sharing my screen at this stage, and we have probably a little bit of time just to go through a few questions. So I'll hand it back to David. I think we'll do the poll.
Thanks both. That was super interesting. It's good to see both sides from the kind of operator landlord and also the data perspective. So we're going to go through the poll questions quickly, the answers, and then kind of get onto the Q&A. So yeah, I think rental growth expectations 2025, 2026 seems like the majority was kind of in the middle there, kind of looking for moderate, not very many on the high end, 7+%, just kind of maybe to be expected. For question 2, so what are your expectations for international demand compared to last year? It's pretty even split between them, but it looks like kind of, you know, neutral to positive. So there's some positive outlook there, which is quite good. And how the overall view towards student accommodation market has shifted in the last 3 months. So again, it's quite an even split, you know, so there's some optimistic response there, kind of a little bit tending towards the Unchained more pessimistic, which is an interesting kind of take. So thank you to everyone who answered in the poll. We'll now move on to the Q&A portion of the session. So kind of just starting off with kind of coming from the occupancy leasing side as well, and some of the things around there. So we do hear a lot about a number of markets being late this year, students being more savvy about pricing and deals. So do you have any views on how this is impacting weekly rents, net operating income versus operator budgets? That's for both of you.
I'm happy to start. I think, yeah, it comes back to the point we mentioned earlier about whether the market is just going to be slower or lower. I think what's interesting, I know we were talking about this in the office a couple of days ago, is the use of incentives. I mean, you look now and there are certain cities where you'll easily find £1,000 cashback, for example, if not more. How quickly those incentives change from a year where there's perhaps very little to last year where they became a lot more common. I think certainly if you're a house hunting student and you saw those incentives coming late in the cycle and perhaps you didn't benefit from them early on, that does incentivize some students to wait, those that can actually do that. So I think that is certainly having an impact. But I do think as well, I mentioned postgrad students, certain universities and certain locations have seen huge volatility in terms of that recruitment. And again, I know we spoke about this in previous sessions. Some universities seeing 40% year-on-year declines in international postgrads. So in those particular markets, there is a risk they will be down year on year. Whereas other markets that have sustained that growth, they might just be a bit slower this year because students are being incentivized to wait. So yeah, I think as always, without trying to sit on the fence, I think there are going to be some markets that do well and some markets that don't, to be perfectly honest, which is no different to any other year, to be frank. But yeah, I think we'll have to see how the rest of the clearing plays out. I don't know, Raffaele, if you want to add anything else to that from a cashback standpoint. I guess you see less of it from a HMO perspective.
Yeah, I think you've got to remember this generation is a lot more used to comparables. Chat GPT, I think you could probably ask it the question right now is if I wait longer, will I get a better deal? And I think it'll tell you the truth. And I think that's where most of them are educating themselves at the moment. I think, again, a great product in the right location holds its own value. But I think if you're on the mist of relying on heavy marketing, heavy incentives, the current client, the 19 to 21-year-old generation, is a lot more savvy than they've ever been, and they could probably, if you're offering them £1,000 incentive, they could probably sense that you're very keen, and they see this type of marketing within their own social lives, so they'll know that there's a chance you could go to, and negotiate an extra space. But also knowing that there's a lots of rooms available gives them the confidence to wait.
Yeah, certainly.
Okay. Just while we're kind of on the cost of let and those types of things, just Raffaele, for you quickly, where you were talking about product, product and location and things like that. So we had a question come in saying if a product is excellent, but the location may be not as good, how does this impact the cost of let on that spectrum of product, quality, location?
I think if you can always focus on the triangle where it's, price, product, location, in reality, if you're really weak, I mean, I always call it like sort of turning the notches. And if your price is really low and your product's really low and your location's really low, then you're pretty aligned, I think that works. I think you can improve a location by improving a product, but you can't take advantage of the price because your prices are capped in certain areas, So I think you just need to find your limitations. And with construction costs at the moment, there are some people just deciding that it doesn't matter what product I create in this location, I'm capped, and it's not worth spending this money on a product that maybe in 3 or 4 years has a sort of more it's pushed back further into demand and supply. So from their perspective, I think if you have the wrong location, it's time to start considering whether in 3 years the location is going to be even worse, or is it worth waiting for the residential fallback, which has happened in certain areas, especially in better areas rather than the weaker areas at the moment.
Yeah,
okay, thank you.
I think to add to that, I think as you say, if they're having to use significant discounts, and as you say, one of those points in the triangle isn't correct, whether that's price, location, whatever it may be. Equally, I agree. I think you could be in a say an opposite view. You could be in a location that's up and coming. So as of today, the product's not right today, but that's not to say that won't change over time. But then you're having to use those tools, incentives to counter that. Yeah.
Okay, thank you both. So we have seen, kind of moving on to talk a little bit about the international and overseas demand. So I think both of you touched on Chinese students demand. So, despite some of the headlines that we're seeing, do you think we're really seeing a reduction in Chinese and overseas students for, say, Russell Group, when we're seeing strong growth in both those categories?
Yeah, I think just reverting back to the data at the start, I think, the UCAS data is pretty bullish. I mean, it's showing continued long-term growth in Chinese demand. I think, I touched on it previously, the challenge, particularly this year and last year, again, I've mentioned this multiple times, but is that volatility coming out of COVID. We saw some universities that had huge growth. Obviously, some of that growth has stopped or reversed. Some of it takes time to play out because the student might be there for 3-4 years, for example. So I think positively undergraduate demand looks good. I think the challenge for the sector, and this comes down to third-party sources like HESA, is the timeliness of the data is just not there, particularly from a postgrad perspective. And that makes it really hard when the market is, or certain locations are relying on those particular demographic or student type. No one actually really knows, to be blunt, about how postgrad recruitment has gone, unless you're speaking directly to universities. So again, I think it will be very much a mixed picture. We've covered postgrads on other webinars. The Office for Students does have more up-to-date data. Again, it's not perfect. So yeah, I think it's hard to give an exact answer at this stage until we kind of get to the end of the cycle, to be perfectly honest.
Thank you. I think we'll probably have time for maybe one more question. So I guess it's for both of you. If we've seen in the data that there's a shortage nationally of PBSA beds. So why would operators not be finding it easier to actually lease their beds in some of these markets?
Raf, I'm happy to go first again. If you want to
Yeah, go for it. Yeah.
Afterwards. I think, it's a good point. I think one of the, challenges with looking or commenting on the data or the market, and we've done this today, we've looked at the national outlook from a data perspective. And when you look at it nationally, it looks fairly positive in the favour of operators and investors. Obviously, we spoke briefly about how the market has changed and has become more challenging, and we kind of do see that reflected in the data. The issue, though, is that really the national picture, which is what gets picked up in the trade press and what gets commented on by other stakeholders for various reasons, is kind of meaningless if you're looking at a Nottingham versus a Sheffield versus a Glasgow. They're all very different. And we see this in the data. And again, in previous webinars, we've explored that for specific locations. And you could have two locations that are the complete opposite. So whilst nationally, when you average or aggregate all that data, it looks, again, broadly undersupplied, there are certainly some markets where it is the complete opposite of that. I think it won't come as a surprise to many. Places like Sheffield have been really tough. And that is very different to places like Glasgow, which maybe not so great this year, but in previous years has been very strong. So every location is very different. And then one step beyond that, we're even seeing within, for example, the leasing data, micro-location. And that's going to also play a role. You could be in a positive city on average, but Raffaele, as your point made, if you're completely the wrong location, you'll underperform, and vice versa.
Yeah, and I think you're completely right. It's about the micro dynamics of each ecosystem. And, yes, there is a supply and demand issue, but if you're in the wrong city, then, there isn't. And I think you're completely right when you say, in the newspapers, they say it's 230,000 beds short in the UK. And I visit many buildings every year where I think, why is 50% of the building empty? And it's because I'm not in one of those key winning university cities. When I am in those cities, they don't need me as an agent, and the properties are really expensive to buy. And the balance is there when the supply and demand is the right city.
Yeah, definitely. I think the other thing we've definitely seen, again, Nottingham, we've looked at multiple times, how those dynamics can shift both relatively quickly, but also over the long term. And some of that stuff we can see coming, again, through the analysis that we're doing, it's more forward looking. You can spot those markets.
And just like I always say to people, Lincoln University is in a position where lots of local students, we don't know which ones are living at home, which ones we don't know which ones are living at university, we don't know which ones in Leeds are moving to BTR markets, or just renting professional HMOs, so it's very difficult with the data, but you do, when you walk the streets, you do sense these things where that, in Bath, you won't see an incentive, and in Lincoln, you will, there'll be enormous incentive. It'll be a race of incentives. So yeah, each city has its own dynamics.
Yeah. Can I just ask you one last question, Raffaele? In terms of incentives and cashbacks, do you get any view from the tenants in terms of are they skeptical about those cashbacks? Do they have particular views on that's great, we're going to choose that property because it has a cashback, or they're actually just looking for lower rent? I don't know if you have any experience of that.
Yeah, my personal opinion is I don't believe in them. I believe in just the correct price. But I understand there are so many reasons why we're all protecting gross rents. That's a difficult, leveraging conversation. It's a difficult market conversation. In terms of incentives, there's absolutely no incentive really for a student to pay £5,000, which is £500 more than he should have gotten, and getting incentives for £500. In terms of when he gets it back, whether he gets it back in, cash, rent, however that is delivered, I don't really believe in it. I actually believe in positioning the product in the right place in the market, price-wise. In terms of them sort of trusting you, it is very difficult when you're out on a viewing, and they've been told they're going to get £500 cash back, or free gym membership, or free bus passes, or whatever the incentive is, to really not say, well, I've got a great product, so yeah, you don't get the cash back, but you get to live somewhere that's great. The incentive becomes eradicated in terms of relevance, so I still think, your product will speak miles, and it's not sensitive such as £200-300 discount or incentive or anything. It's not that sensitive. If they find the product that all 5 students love when they're walking around, the emotion eradicates all the incentives that you can put in place.
Yeah, I appreciate that. It's good to get your views on that.
Cool. All right. Thank you both. Yeah, that kind of wraps up the Q&A session. We're out of time, but we managed to get some interesting perspectives, kind of at both like data and then sort of, in the city, operator on the ground kind of aspect as well, which is really good. So any outstanding questions that we weren't able to get to in this session, we'll try and address in our usual kind of quarterly roundup blog. So please keep an eye out for that in our content hub. As a reminder, recording of this session is going to be shared. Follow us on LinkedIn, sign up for our newsletter to get trends, insights from the intelligence team. So just another big thank you to Rich and Raffaele for sharing insights, all of your comments and the Q&A answers. And thank you to everybody for joining the call. So we hope to see you all again soon, and enjoy the rest of your afternoon.
Thank you very much.
Thanks, everyone.